Yeah, good afternoon, MarketChameleon.com. .com or .com? I'm in Spanish still. I'm Adam. That's Dimitri. How's it going today, Dimitri?
Good. How's it going, Adam?
Great, man. Do you got your chameleon cup over there?
No, I didn't get mine yet.
What?
Yeah.
What do you mean you didn't get yours? Will's got 800 of them in his garage.
I don't know. People have been complaining they haven't been getting their cups, and I'm like one of them.
Makes no sense. Everybody, Dimitri, why don't you go ahead and share your screen there, brother?
Right.
Remember, everybody, option trading, just like getting a chameleon cup, can be a little bit risky. You got to do your research and trade your own. Do not look for us for advice. We were just giving you some information, some tips, some things to think about. But really, it is all on you. I had a guy contact me today asking me about stock tips. Man, that's not what we do here. Please, never listen to me or anybody else on this show about what to do with your money. For gosh sakes, do your own research,
Adam,
guys.
Are you seeing my screen or no?
Yeah, I see it. Why don't you go ahead and bring up the Chrome for us there?
Okay.
Remember, everybody, click the subscribe button if you're on YouTube right now, and tick that bell if you want to catch us live here every day, Monday through Friday. So, what are we gonna go over today, Dimitri?
Okay, as usual.
Man, what is the deal with this? Why every time I go live with D, every time it loses it, man. Every time. What's up with that? Anyway, we're gonna dive into this. You know what I think it is? I think we got a glitch in the system. Is what I think we got. Dimitri, I just figured out what I think it is. You know what it is?
What?
Can you hear me?
Yeah, can you hear me?
You got me?
Yeah.
Yeah, you know what it is? I think I got this like streaming thing. It's called a Stream Deck, and I can push it. It's the thing that gives me the moves, like to my face, to your face, to the split screen. And there's one button on there which sends out this thing to YouTube, like, hey, YouTube, it tells people like, hey, we're live, here's the chat, whatever.
Oh.
And when I've hit that, we lose the connection. So that's got to be it, man. Yeah. That's the flaw in the system, man.
All right, because it's been happening
every time, and
I
just noticed it's when I go back to you and I hit that thing, and I'm like, oh, there it is, man. There's the bug in the machine, man.
Yeah, every time you tell me share your screen, my hands are shaking, and then you're gonna say you got to get rid of your Comcast, and I'm like, okay, well,
here I am telling you got to upgrade Comcast, you got to switch your carrier. No, man, it's me. It's the Stream Decky thing I'm hitting down here. Anyway, Go ahead, share your screen. Let's see how this works this time, man.
Okay, let's go.
Let's see how it works this time. Let's see if you can pull it off. If the if the tech is good, man. Go ahead. Whew.
Okay.
You know what it is? That's funny. Well, I'm hoping it's that. It did work at the exact time I hit that button. We lost the we lost the connection, and yeah, we got you now, brother. You're up.
Okay, just so you see my screen now.
Yeah, totally. Okay. We got you.
Okay, so. As usual, I just start with the SPY. I'm going to just continue on, showing examples with this stock, and I'm just going to go through my notes. What we talked about before, we talked about the importance of having a valuation model, how the difference between what a retail trader is looking at, what a professional trader looks at.
Yep.
And we kind of gave a really quick example of trading price. Right.
Yep.
People trading price versus a professional trader who would actually take. Here, I went over here.
Yeah, professional trader actually looking at value. Mm-hmm.
A value to trading price against the value.
Yep.
It could be a theoretical value, but a value. So in this example in SPY, we just gave it. You would take the components, take the weightings of each component, and then figure out what the net asset value is and compare it to the stock price to see if the price is undervalued or overvalued.
Yep.
So I'm going to move on from there, and we're going to keep building the blocks for a valuation model. We're also going to talk about edge, which is a trading advantage.
Yep.
And trading rules. But before we do that, I did want to talk about option skew, this is a little bit difficult to explain. I'm going to try to. I was actually nervous. I was practicing a little bit.
Dimitri,
so I'm going to try to explain
Dimitri,
Yes.
Do or do not. There is no try. Haven't you watched Karate
Okay.
Kid, man, or whatever that movie's?
Yeah. And I did get emails requesting to explain it,
Sure.
so I'm going to try to do that, and then we'll talk about put call parity and hard to borrow stocks. Uh,
Cool.
so when we talk about skew, and I'm just going to go out like to a little bit further out in SPY,
Mm-hmm.
we did talk about the implied volatilities, how the Black-Scholes model, or in this case binomial model, converts the price into an implied volatility. So then we could compare options on a relative value basis. And you could see we did talk about a little bit how the implied volatility increases as the strike prices go down and decreases as the strike prices go up.
Right.
Okay. The the underlying assumption when in the Black-Scholes is one, when we start out. So this stock's, it finished 279.21. So this is like right at the money strike price,
Okay.
279. The assumption is in the next 10 days, we don't know if it's going to go up or down. It's 50-50, right? It's random. It's either going to be up or down in the next 10 trading days. There's no way for us to predict that.
Right.
It also assumes that there's a normal distribution of returns. So it's either going to, just to simplify it, it's either going to go up $5 or down $5
Sure. Mm-hmm.
next 10 trading days, right? And I'm just going to take a look here. See, so March 13th, I'm just looking at what the straddle is priced at. So it's 1.8% or $4.93. So it is about up or down $5. All right, we're just going to round it to 5. And so if that's the case, right? If that's the case, and given all those assumptions, right, we should be able to create some kind of model, maybe with a theoretical edge, if those assumptions that the Black-Scholes model is correct. Okay, and let me try to explain it this way. So let's say we have a game of heads and tails,
Mm-hmm.
right? It's 50-50, so it's either heads, right, or tails.
Right.
Okay. It always does this. Tails, right? And let's say the payoff. It's very easy. If you bet on heads and you win, the payoff is $1.
Sure.
Okay. And if you bet on tails and you win, it's $1.
Yep.
Right. So if you bet $1 on either one of them, it's a 50-50 shot. In the long term, it's a break even.
Sure.
All right. Now, let's pretend that we have this at risk. If you want to bet on heads, it'll cost you $1. If you want to bet on tails, it'll cost you 90 cents. Okay. When you look at this, then there's an edge.
Sure.
Because you have a 50-50 shot of winning $1, but this will only cost you 90 cents to play. This is $1.
Sure.
If you, in theory,
Sure. I
let's
mean,
just say,
you play that all day long. You may lose, but the odds are in your favor, right?
the odds are in
Simple.
your favor
Yep.
over the long term, right? So let's say we did 10 spins, right? 10 spins. Oops. 10 spins, and 5 times, right? So 5 times we lost,
Yep.
right? So we lost 90 cents. So
Yep.
5 times we bet, we risked 90 cents,
Mm-hmm.
right? And we lost 90 cents. So that's $4.50,
Yep.
right? And then 5 times we won.
Sure.
We won $1, right? So that's $5. Right? That makes sense.
Mm-hmm.
So for every 10 spins, if this was exactly 50-50, right, we would have lost $4.50, and we would have, in our winnings, would have been $5.
Yep.
So that's how we make. So that's our edge, right? 10 cents.
Yep.
All right, just 10 cents. So does this make sense?
Absolutely.
Okay.
Yep.
Now let's go back to the SPY. So the assumption here is if I start out at 279, it's an equal chance of going up or down $5, right? We said, that the straddle, right? The straddle is worth almost $5.
Gotcha.
Okay. We don't know if it's going to go up or down, but it's 50-50. It's either going to end up from here. Let's just play it exactly like $5 to make it simple, right? So it's either going to end up where 274 or where is that? 284.
284.
Right.
Yep.
284, 274. Let's write that down. So we start out
at 279.
279. Right. And the put, right? And it's going to either end up, right, what did we say, 284?
284. Yep, $5 up.
Right. Or you know what? Let's play it down. Let's do it this way. And then 274. Right, $5 down. That's where we think it's going to end up, 50-50. Okay. And now here's the thing. This is telling us, right, between 282 that I'm moving up $3.
Sure.
Okay, from 227. It's telling us this is a relative value. This is 10.1 volatility.
Right.
And then I'm moving down the same amount to 276.
Yep.
Down $3. This is telling 12.4 volatility.
Gotcha.
So this on the relative value is cheaper than this.
Right.
This is what the Black-Scholes, which it is, and we're going to take a look, and I'll explain why it's that way. But so for 282, this strike 282, this option is $1.21. Let's write that down. Okay, I could buy the 282 call 282 strike.
Yep.
And what did I say? It was $1.21?
Yep.
$1.21. And let's get the other part of it. Now I'm going to go down the same distance to 276. Okay, $3 away. So I went $3 up, $3 down. It's $1.41.
Right.
So the put 276.
Yep.
Right.
For $1.41.
That was $1.41. Oh wait, this is gonna cut off. So it's got to do this. $1.41.
Yep.
Okay. Now you could see that the 282 is a better deal on a relative basis because we don't know if it's going to
I get at 50-50. Yeah.
It's a 50-50 shot, but this is much cheaper to play than this shot. That you see that, correct?
Absolutely.
Now, all right. So if we're playing a 50-50 shot,
why don't people just play that all day long? That must just be that's easy money, right? You should be retired on Easy Street right now.
Right. So from 279, from 276, we could sell the overvalued one, the put. Right. So we sell the put. Sell the put for $1.41.
Yep.
And what will happen is if it goes up, we'll make money on the put. If it goes down to 274, we're going to lose. So, between the strike prices, 276, it's $2. So we're going to lose the difference. At the same time, let's buy the call. All right. So now we're buying the call.
Right.
For $1.21. That makes sense?
Yep.
So far what I did.
Yep.
This is called the risk reversal, actually.
Yep.
This is what it's called. So my credit in this situation is 20 cents. I net received 20 cents because I sold something for $1.41
Sure.
then I purchased something for $1. I sold it for $1.41 and I purchased something for $1.21. So I received a net credit 20 cents.
Yep. Yeah, we talk about these all the time. Yeah.
Exactly. And so what's going to happen here? Okay, there's a 50-50 shot. It goes to 274. So from 276 to 274, this put is worth $2. So I lose, right? I lose $2, right? I lose $2 and minus the credit of 20 cents, right?
Right.
So minus the credit 20 cents, so I lose $1.80. Okay, in this situation, everything holds true. I lose $1.80. If it goes up to 284, right, from 282 to 284, this call, now I'm long this call, so I make $2 on the call, plus
your 20
cents credit, right? Plus my 20 cents credit, which is $2.20.
Yep.
Now, this is what the Black-Scholes, it's saying 50% of the time we're going to make this, 50% of the time, just like we did it over here, right? 50-50.
Yep.
Right? 50-50, right? This is what we just recreated was that assumption, this assumption.
Yep.
We just did it over here.
Yep.
Right? So over time, obviously, and this is how the skew usually lines up, right? This is not an abnormal skew.
Sure.
This is usually how the skew lines up. So then we should check, well, are we missing something? Maybe it just tends to go down more than up, right? Maybe it has really big down moves much more often because look what I did. I didn't pick the tails, right? I didn't pick like way out here. These aren't the tails. I was even within the 1 standard deviation. I didn't pick anything out crazy. I picked them up really cool. So let's take a look at our price return distribution. So here, SPY, and I already set this up. So we're going to look for SPY for rolling 10-day periods. So in a 10-day stretch, what were the returns historically? And I looked last 10 years. Okay, last 10 years, can do 12 years. In the last 12 years, over a stretch of 10 days, how were the returns? So you get the results over here. So these are the results. Actually, it's in our favor because usually they're positive with the positive skew. And this here is a quick check. So let's just see how frequently it made 5% moves, up or down, right? And here we could see below 5%, that's happened 5.4% of the time, above 5. So it does a little bit more in the last 12 years. Let's see in the last 10 years. Let me see this. So in the last 10 years, which is what I was looking, because that was, I think, also in 2008, it included, but in the last 10 years, you see it was actually the reverse. It made more moves above 5% than down 4.2% of the time, right? And you could see, you could kind of see it over here, above 5%, below 5%, 3.7% of the time, 4.2%. So it's not very conclusive, but you could see it's not overwhelming that it's going to have to go. It has that many more moves down than up.
Right.
It's almost 50-50. So why is that happening, right? Why is it lining up? Because it just seems like an arbitrage opportunity. And there are times to actually trade the skew. This is professionals do trade the skew. And they also actually look at the skew to give them a clue when the skew really moves of where the stock might even be going.
Right.
Because the skew will fluctuate.
So are they looking at skews like over historic periods for particular stocks to try and look for moves within that stock, basically?
Yeah, exactly. So it could actually give you an indication by studying, what is an average normal skew for a 10-day period.
Sure. Yep.
Right. And they'll watch, and this is how it'll probably line up somewhere close to here, but sometimes it will start moving in a way where it's telling you it's about to make in one direction, something's happening.
Right.
And really it happens because a lot of people with a lot of information are trading. This is like the SPY, SPX. So they see the the liquidity of the books all over the place.
Yep.
Right? They know if the liquidity in the books, if all the bids underneath underneath the NVB are disappearing, right? They're going to know this because these are professionals making these markets.
Sure.
So, and I just wanted to kind of show you, why. So there is a reason for this skew to be there as well.
Yep.
And one of the reasons, I'm going to try to draw this out. Let me bring up a different thing. In the Black-Scholes model, one of the assumptions is that if a stock, is at $100, and if the stock moves to $105, okay, it has to trade at every price. It trades at every price in between before it gets to 105. So it has to trade at 101 cent, at some point 102 cents, 103 cents. So it's going to assume that it trades at every price in between before it gets to 105.
Oh, but that doesn't happen, does it?
So no, not all the time.
Sure.
It doesn't look at. It doesn't. Remember, we talked about gaps,
sure,
right, and misprices gaps. It also doesn't take into consideration the speed of the move. So how fast it gets there also matters, because it assumes that you're able to continuously re-hedge your delta.
Right.
And I'm not going to explain. That might be a little bit overboard explaining what it means to continuously re-hedge your delta, and I'll get into it when we get more advanced. But I'll try to kind of describe it in a way that people might understand it when in their trade. Okay, let's do this. I'm going to draw two scenarios. So the first scenario is when a stock, let's just say, your put option, the stock goes down very gradually. And it takes a while, or goes up very gradually. Either way, but let's just say it moves very gradually. And it'll look like this. It'll go up a little bit, then it'll go down a little bit. Oh, oops.
Look at you with the paint, man. You're like a pro painter.
Well, I was watching.
Who's trying to get you to change to Mac, man? You don't need a Mac. You're all about the PC, man. You're loving the PC, dude. You can never change, man.
I was trying, because I use Paint, and I was looking at what other people who are holding classes, and they have these like fancy words.
Yeah, dude. No, I mean, most people don't even know Paint is even on their computer.
Yeah. So. And let's just say it takes, I know this is taking a while. I'm almost done. And let's say this, it went from $1 to $5. Okay. And it took, and to get all the way up there, it took like the full 10 days. On day 10, that's where it ended up.
Gotcha.
$5. All right. Now let's say we have the same scenario, and it starts at $1, then it moves. Starts at $1, moves.
Dimitri,
really
you want a super pro tip, dude? Do you want me to change your life right now, dude?
Yeah.
Control Z. It's undo, my friend. You ever used that one before, dude? I just made your life so much better, dude. No more goat hunting for that back arrow thing. Control Z, my friend.
Control Z.
Yeah,
okay.
Like if you want to undo whatever you did, Control Z. I told my wife that. She's like, I don't want to use that.
Yeah, I'm not going to use that either. So
I don't want to do that. I like the back arrow.
I'm going to try to.
All right, yeah, man.
I have to get used to it. In this situation, this is what happened, and this is on day 10. Okay, day 10. Day 1.
So it did the
And in
same
this
thing. It
situation,
just did it in one
this,
massive jump. That's what you're showing with the chart here.
what's that?
You're showing us that it basically did the same thing. It just
Right.
rather than doing it gradually, it did it over. It did it with one big jump, basically.
Yeah, it did it one big jump, and at the end of the day, they're both worth $5.
Gotcha.
Okay,
Mm-hmm.
so these options are both worth $5 at the end of the 10 trading days.
Mm-hmm.
But this option at the start, if you think this is going to happen instead of this, is actually worth more than this. Okay, even though you think it's going to end up here and this is going to end up, because of this, because it's moving slowly,
Yeah.
it's worth less than if this one moves really fast.
Huh.
It has to do with rehedging, but I'll try to explain to you maybe in other terms that people might relate. Imagine here, you own this option. The first day goes from $1 to $1.10.
Mm-hmm.
Then it goes to 90 cents. You're like, oh,
right.
Should I sell it?
Right.
What do I do?
Sure.
Stop loss. Right. The next day goes up here to $1.30. You're like, oh, I got it back. Should I sell it now?
Sure. Yeah.
Right.
Mm-hmm.
You're out. All these, you see all these places, before it gets to $5 in this situation, there's a lot of room here that you're going to make mistakes.
Absolutely.
Here, over here, it didn't you just woke up, boom. Like Dimitri, you didn't have you couldn't have done anything stupid, right? Yeah. You couldn't have made any mistakes. It just went right there.
Yep.
Does that make sense? Why?
Dude, it's the Bitcoin conundrum. I told my brother, I told Will, I told Will about Bitcoin when it was at 32. That was the first time it popped on my radar. And we were debating it, buying or selling it right then. And people were like, oh, you really missed out. It went to 20,000. I'm like, dude, we didn't miss out on anything. If we bought it at 32, we were out at 42. Yeah. You know what I mean? There's no, that's just that's human nature, right?
Human nature. Right?
Yep.
And that's kind of like the idea also with the rehedging, because if you're rehedging at each point, the option, you're at the end of the day, you made a lot less than if it just did
Absolutely.
This.
Yep.
And that's why when we look at this skew, that's the assumption. It's 50-50 if it goes up or down, right? We don't know. And the distribution, it's either up $5 or down $5. But the assumption is that if it's down, it's going to get there. It's going to get to this price much faster than to this price.
Gotcha. Makes sense.
That's why. That makes sense?
Yep, absolutely.
Okay.
Yep.
Okay. So that's kind of why part of why the skew is there. All right. That's one of the explanations.
Sure.
Why it exists. So let me take a look. How are we doing on time today?
No, just go for it, man.
Okay. Let's talk about hard to borrow stocks and put call parity. So this is the other assumption. So the other assumption in the Black-Scholes, and remember the Black-Scholes, and we're using the binomial now, but it's the same assumptions in both, is that you could borrow and lend at the same rate, and you could buy and sell short stock. So so it's just as easy to sell short a stock as it is to buy a stock. Okay. And that's not always the case. And when that happens, and there's no component in the Black-Scholes model to say you can't short a stock.
Sure.
It doesn't exist. It's always so it always assumes that there's a put call parity that you could do an arbitrage. And I'll show you really quickly. Let me look at my hard to borrow list. I have to find a situation that I could show you.
Wow, look at that. I didn't even know that was in the Chameleon. Learn something new every day, guys.
Yeah. Well,
hard to borrow products drop down. Wow, that's amazing.
Well, this is actually my report.
Oh, did you? Okay, I was like, whoa.
Let me just take a look at the price of this stock, NIO. Let's see if it'll work on this. So an NIO, let's come out. I forget which. Okay, let's take a look at here. So what's going on here is this stock, what this is telling me is hard to borrow. That means you can't really go to a brokerage firm and short it.
Gotcha.
It's almost impossible to short it.
Yep.
Almost for anybody, because look at the markets here. It's saying that I'm just going to take this 10 strike, right? This is 50 implied volatility. This is, and the corresponding put is 136 volatility. This is just telling me, unless there's a big dividend that I don't know about, which I doubt. I don't think this is the case here. Let's just assume it's not. This is telling me that it's very difficult to create an arbitrage by shorting.
Mm-hmm.
And here's how an arbitrage would look if you were able to short it. So here we have the 10 strike. If we buy the 120 call, if we buy the 10 call for 120,
mm-hmm.
if we buy the 110 call for 120, and then we sell the put for 330, right? So we buy the call for $1.20. That's like add $1.20 to $10.
Right.
That's $11.20. It's like, let's just say it's like you buying the stock for $11.20. If the stock keeps going up, it's like owning stock above $11.20, right? And then at the same time, we're going to sell this put for $3.30. Okay, so we're going to sell the put for $3.30. That brings us down our cost basis to $7.90.
Right.
Right. So it's like synthetically
sure.
we bought the stock for $7.90. Because if it goes to zero, we're going to lose on this put.
Sure.
Right. Until it gets to zero. If it goes to infinity, we're going to keep making money on this call until it goes to infinity. And we've received about $2.10. So because we received $2.10 minus $10, that's like buying synthetically this stock for $7.90. Now you could see if you actually want to buy this stock, right? If you're actually like very bullish on it, a synthetic long is a much better deal than just buying it outright. Because if you're going to hold it if you intend to hold it past this date,
yep,
July 20th, you're getting like a crazy deal then, right? Because you're buying it $2, almost $2 under, $2 under the price.
Right.
And there's no way. And the reason it's like that is because the market makers, they just can't short the stock. They can't short the stock to create that arbitrage.
Oh, that's
right?
interesting.
If you could synthetically buy for $7.90,
yep,
and then short it for $9.85, you just carry that position. You hold
sure.
it until July 19th, and it's gone.
Yeah.
Right. Then it's gone, and you make the spread.
Interesting.
So that's that. Now there's no.
See, now I know why this is. I didn't realize you guys had a whole internal website. This is like the super secret stuff, man.
Yeah. This is Well, we release it a little bit at a time.
Yeah, of course, man.
We release things a little bit at a time.
Well, you fat cats get rich on it. I'm laughing. Dimitri's on, and we don't get rich on it. None of this stuff is easy, guys. Everybody knows none of this stuff. It is not easy.
It's not easy.
Nope.
It's not easy, and this stock may go right. It may go down.
That's right.
You could put on that synthetic, and you could still lose a lot. I don't know what it does, but that's the idea behind the put call parity when you can't short a stock.
That's super interesting. I never knew that about how the shorts can really affect that. That's interesting.
Yeah.
Yep.
Yeah. It'll be out of line. So synthetically, you actually get a big discount.
Mm-hmm.
Right. You get a big discount to just buying the spot price.
Very cool. That is
okay,
dude. That alone is worth the price of admission today. That's awesome stuff, Dimitri.
Yeah. All right. Thank you. So, you think that's good for today?
Well, I mean, I think that's good for today, man. I think you brought a ton of stuff for everybody today, man. That is
okay.
That's full on. That is full on stuff today. Why don't you bring your face back up so you can say goodbye to everybody? Remember, everybody, click the subscribe button if you're on YouTube, following us on YouTube. Tick that bell if you want to catch us live. And we will be here. What days? I always get confused about the days, man. I'm always living the dream here. What are we on today? Wednesday or Thursday?
Wednesday.
So we got 2 more days of this week. 2 more days with the Chameleon in the afternoon before we go back. I think Will's getting back on Monday. Are you doing the Monday show?
I thought he said he's come back Monday.
Friday's he's gonna be back. I don't know, man. I haven't received any photos. He might be shipwrecked somewhere. Really? You know, I haven't received any photos the last couple of days, so who knows?
Miss Will.
All right. Great show today, man. I appreciate it. Everybody have a great day trading tomorrow, and we'll see you tomorrow afternoon. Take care, everybody.
Bye, guys. Thanks.